Get Rich Education is brought to you by Ridge Lending Group, the Real Asset Investor, and Corporate Direct. Cash flow real estate investors, this is Get Rich Education's Keith Weinhold. Did you know that you can finance up to 35 income properties all with one lender? Ridge Lending Group specializes in investment property loans, and they do it in almost every U.S. state. Ridge has worked with tens of thousands of real estate investors and homeowners all over the country. They've been doing this for investors for so long that at this point, they've helped more families realize their dreams of becoming real estate investors than any other mortgage lender in the country. To find out more, visit ridgelendinggroup.com.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Hey, welcome to Get Rich Education. This is episode 113. I'm your host, Keith Weinhold. We are going to build your wealth today. If you're willing to take a 15-minute Denny's survey to get free moons over Miami or some zero-impact nonsense like that, then this is not the show for you. Instead, expand your means and build durable streams of passive income. Today, we're going to do that by talking with one of America's foremost experts in mortgage note investing. So we're talking about how you can achieve a stable 9 to 10% annual cash flowing return when you're the bank. Yes, you're the lender rather than the mortgage loan borrower. And as the lender, your investment is secured with a property as collateral rather than buy and hold real estate investing where you're the borrower. When you're the borrower, the bank has your property as their collateral. So then in a similar way, when you're the lender, now you've got your borrower's property positioned as your collateral in the case that they would default. And unlike peer-to-peer lending platforms like Lending Club or Prosper, where you don't have a property as collateral, this is real estate investing, and it's somewhat higher level and more sophisticated. But the thing is that as the mortgage note lender, you're able to achieve income from a higher interest rate, maybe 9 or 10%, a higher interest rate than you pay when you're a Fannie Freddie borrower on your income property, where you might pay closer to 5% as the borrower. I am back in Anchorage today from my real estate field trip to Dallas, Texas. I'll share coverage of that trip somewhere else, maybe in our free newsletter, which you can get at getricheducation.com, as we've got a lot of ground to cover today. Next week, geopolitical strategist Peter Zion returns to the show, and he'll tell us what states and places in the U.S. have the brightest economic futures and which ones have futures that look rather dim. And we're going to chat region by region and even state by state with this. For example, we'll be talking about like Ohio's fortunes are declining for these reasons. Alabama's economy is poised to thrive, and here's why. Or capital is fleeing California and headed to Texas, and here's why. So I just made that up. Just an example there for next week. And Peter is an astoundingly well-connected guest that works with intelligence agencies. And you know, that stuff right there, that's hugely critical to your real estate investing, because a thriving state or metro economy with job growth, that means that all at the same time, your property appreciates and your rent income increases and your occupancy is higher. But today we're talking about you as the lender rather than the borrower through mortgage note investing. And how do you recognize a good mortgage note from a bad mortgage note anyway? And then you're going to want to be sure that you're profitable if you're repaid by your borrower. And you're also going to want to be sure that you're profitable in the unlikely event that you're not repaid. And I'm going to try to ask today's guest sort of the questions I think that you would want to ask him. And we're going to discuss what to be careful for first, and then the benefits of mortgage note investing. I'm also going to ask our guest to give us a real life example with numbers. And then I'm going to use a calculator during the episode to tell you just how many dollars of monthly passive cash flow this can create for you. Today's guest started investing in real estate part-time while he was working full-time as a high school band director with zero net worth. Within 6 years and before the age of 30, he became a financially independent millionaire through part-time real estate investing. He left public school teaching in 2005 to focus on real estate development and commercial real estate investment brokering. And just look at the experience he's had. His company's investing and advising has included single-family homes, apartments, office, retail, medical, condo conversion, net leased properties, syndications, production home building, land development, private lending, and winery, and he's been featured on some of America's top radio shows. His blog, HassleFreeCashflowInvesting.com, has been repeatedly named one of the top 100 real estate blogs in America, and I've read his blog a number of times, and I've learned from it myself. He's widely recognized as a cash flow investing expert, and his transactional experience is now approaching the $1 billion mark. That's billion with a B. Welcome back to Get Rich Education, Hassle-Free Cash Flow Investing's David Campbell.
Hey, Keith, I am so excited to be here with you on our 5th podcast together. Gosh, I just love our time together.
It is indeed your record-breaking 5th appearance, breaking the tie that you had with Tom Wheelwright for 4. So the GRE appearance trophy is back on the Campbell mantle.
I should call Tom and just give him a big neener. Come on, gotta catch up.
Yeah, he is slacking off. You were here on episode 51 with me. Although you've made 4 prior appearances, your first appearance on that episode was where we discussed mortgage note investing, and that intrigued a lot of people. Rather than investing from the equity side, one can essentially be the bank and invest from the debt side instead. So we're going to cover some of the same ground and some new ground that we did on that previous episode. Why is now a good time to move some chips away from the equity side of the table and onto the debt side?
Well, when I'm looking at market cycles and I'm looking at an investor's personal need for liquidity and for risk tolerance and what benefits they're looking for from their investments, those are chronically moving variables. And so the market cycle at any given time could be a buyer market or a seller market, but there's always a demand for capital. There's always a demand for money in doing real estate deals. There's always people who need a home to live and they need to borrow money to do that. There's always developers who are borrowing money and rehabbers who are borrowing money. And at any given time, the lending standards are changing such that a person might not be conventionally bankable, and then they need a private lender to fill that gap, fill that void in the marketplace. And so in many ways, I look at lending as being more resilient. It is more of a durable business model than buying and selling real property. It's more resilient from the fluctuations of market prices. They're not completely insulated because as prices go up and down, that could definitely change an investor's risk position if they don't have enough protective equity. But it's definitely, I think, a lower risk, definitely lower hassle approach to investing than being a direct owner of real property.
Yeah, so we're talking about meeting a need, and we talk about turnkey real estate investing and traditional buy and hold sort of equity real estate investing here on this show. And we're creating value for society by providing them with housing. We're meeting that demand. So the demand that we're meeting by being on the other side is a lender, is a demand from a prospective borrower. They need a loan. They can't get a loan from a bank, so we could potentially give them a loan. Now, why can they get a loan from the bank? Why do they need us?
So when we're looking at a traditional lending situation, the lender is going to look at the borrower's income. They're going to look at their debt to income ratio. They're going to look at their credit, and they're going to look at the collateral. So we might say it's their credit, their capacity to pay, and the collateral, the 3 C's of lending. And if any of those C's are deficient, the credit, collateral, or capacity to pay, then a bank will say, no, you don't fit our lending criteria. Or it could be a very common sense loan that their credit, capacity, and collateral are all really good, but there might be some oddball things such as the borrower's citizenship or their length of employment, or they might be self-employed and having so many deductions that their debt-to-income ratio is not conventionally bankable. Sometimes it's collateral. And that's the case with rehab borrowers, where they're buying an ugly house and they're making it pretty. And if they went to a bank, the bank would say, no, we won't do a conventional loan on this because the collateral itself is deficient.
Yeah, the conventional lending environment is still relatively tight as I see it. It's probably not as tight as it was 1 to 2 years ago, but I think as a lot of our listeners know that they might have been rejected for a loan while it's very much within their capacity to pay realistically. They just don't fit inside that institutional lender's box, where that institutional lender has to meet criteria to go sell it out on the secondary market. And of course, us as mortgage note investors, individuals, we don't necessarily require that. And before we move on, David, I just want to talk about other terms sort of synonymous with what we're talking about today. We're talking about mortgage note investing today. There's some other terms that are quite synonymous with that, similar or nearly the same, like private lending. We're talking about hard money lending. What are some other similar terms?
So the general concept is you are giving someone money, or you're renting your money to someone, and then there's a piece of collateral securing that rental agreement or that loan agreement. And so in different states, the collateral agreement or the security agreement is called different things. So in some states, they use a mortgage, which is a type of security deed that you have to foreclose using the judicial system. So that's called a judicial foreclosure instrument, a mortgage. A deed of trust is another form of security instrument that allows you to force the sale of the collateral to get repaid as the lender. And a deed of trust is a non-judicial foreclosure instrument. So a lot of times you'll hear people say, oh, I'm investing in mortgages, when they're really meaning they're investing in a deed of trust. Or you can say, I'm a trust deed investor, and what they really are renting their money out to a borrower secured by a deed of trust. And that deed of trust, I'm going to be redundant, it's the thing that gives the lender power of sale. And that's the thing that makes mortgage lending, private lending, deed of trust lending, trust deed investing, those are all synonymous, loosely synonymous terms. And that power of sale is the thing that creates security for the lender. Because when I'm doing a loan, I want to ask two questions. Am I profitable if I'm repaid? Am I profitable if I'm not repaid?
Right.
And the vast majority of loans really are repaid. And so you could do your analysis and say, majority of the time I'm going to be repaid. But what if I'm not? What if I'm not? And if you're not going to be repaid, you look to the collateral itself, which in our industry is a piece of real estate. And that piece of real estate has intrinsic value. And that security deed puts you ahead of almost all other creditors. And you say, hey, world, this deed of trust, I'm putting you on notice that I have a priority lien over everybody except the government. And so the government, through property tax liens and sometimes income tax liens and sometimes through senior utility liens at the city governmental level, those could sometimes sneak in front of you as a first lien investor. But by and large, you are the senior creditor that has the right to force the sale of the property and get paid first at that foreclosure sale.
Okay, so just to sort of summarize and pull back at the same time and get more general here, whether we're talking about mortgage note investing or their sort of synonymous terms, private lending or hard money lending, we're talking about the opportunity for a lender, me or my listener here, to get maybe a return of about 10% or so, a pretty stable return of 10% on a cash flow basis. And we're talking about the distinction between mortgages versus deeds of trust. So it's preferable, it sounds like, to invest in states and structures where we had a deed of trust in place, where we don't have to go through a judicial foreclosure process in the event that that borrower cannot make the repayments to us. Therefore, it would be easier to go ahead and get our collateral, get that property.
Correct. Yeah, a deed of trust is easier, faster, lower cost to foreclose upon. And when we're talking to prospective investors about investing in mortgages, the conversations are highly focused on the collateral and the foreclosure process. But in common practice, very few mortgages go to default. When we're looking nationwide, and about 2% of mortgages nationwide go into foreclosure or go all the way to the bank. More mortgages go into default, but only about 2% of mortgages nationwide actually become foreclosed REO properties. And then when you look at a data sample of properties with equity in them, because remember that the data sample of across the country is primarily borrowers with little or no money down, like FHA 3.5% down. That's not enough protective equity for the lender, but the government, to stimulate housing, is willing to take that high loan to value risk. As a private lender, we want to be 80% loan to value, 75% loan to value, or lower, depending on the quality of the collateral and the marketplace that collateral is in. And when a borrower has that much equity, 20 to 25% or more equity in their home, it's extremely unlikely that property will go to foreclosure because the borrower has the option of selling. They can put a for sale sign in their home and sell the home, and there's enough to pay a broker and to pay off the loan. And then they've protected their credit and they're more likely to get some cash from the sale. So when we look at that data sample of properties with equity in them, extremely small rates of foreclosure. However, it's a known risk, and so we definitely talk about it a lot. And that rate of foreclosure definitely increases in down markets, because if you loaned $75,000 on a $100,000 property, that property value declines to say $60,000, and the borrower owes $75,000 on a $60,000 home, you're definitely going to see foreclosures increase because the borrower has no equity in the home. They're over leveraged. And so when we're doing our lending, we definitely care about the equity in the property, but we also look very heavily at the property's ability to generate income. So we look at the rental potential for a property when we're making a loan. Because I want to know as a lender, if I take back a property that has gone down in value, I know as a experienced real estate investor, home prices generally move faster than rents.
Right.
It's pretty common to see home prices go up and down, especially in major metros. Rents don't usually go down. They go up and then they stagnate, and they might go down nominally, but you don't see rents fluctuating in the same volatility that home prices do in major metros. Small towns, of course, you have movements in rents based on supply and demand and employers moving in and out, et cetera. But in major metros, rents are pretty much a constant or keep pace with inflation, et cetera. So when I'm looking at a loan and I'm looking at that ratio between rent and the mortgage payment, I want to see that my borrower has a mortgage payment comparable to rent, so that if they were to be faced with troubled times economically, they would say, I could make my mortgage payment, or I could lose my home in foreclosure and move across the street and pay the exact same payment in rent. There's an economic incentive to keep that borrower retaining that payment when that rent payment and home payment are commensurate. Also, I'm looking at protecting my yield, because the value of a property only matters if you're selling or refinancing. And so if I get property in foreclosure, which is extremely rare, but if I do get a property in foreclosure, I could sell it and get my money back, or I could rent it out and get my yield that way. And I know that if my rental income is comparable to what my interest income would be, then that gives me a secondary protection in my investment.
So when we were borrowers and we want to go ahead and get on the equity side of investing, we might be thrilled to have a 3.5% down FHA payment. But when we're on the other side of that as borrowers, that's not much protective equity. That's not much of a buffer. So we're looking for deals where the borrower has at least 20 to 25% equity in it. That's part of our protection. That makes it a lot less likely that they're going to walk away. We've been talking a lot about the risks of mortgage note investing, but what are the benefits? We're going to come back and talk more about that. You're listening to Get Rich Education. Our guest is Hassle-Free Cash Flow Investing's David Campbell. More when we come back. I'm your host, Keith Weinhold. As a lot of investors know, multifamily real estate has been one of the best asset classes to be invested in most of the last decade. While the great deals have been harder to find lately, there are still opportunities in select markets where savvy investors can get lots of appreciation and strong cash flow if you have a great team. Dave Zook, founder and president of The Real Asset Investor, and his team have been very active in the multifamily space in Memphis, Tennessee. On the heels of the Great Recession of 2009, Dave and his team quietly started acquiring multifamily assets, and in the last few years, he has syndicated over 2,000 apartment units, creating strong cash flow streams and big appreciation for lots of their investors. It's not too late to get involved. If you're an accredited investor and you would like to learn more about investing in great multifamily apartments with a world-class team, email Dave and his team at info@therealassetinvestor.com.
You've worked hard to acquire real estate. Don't lose it in a blue instant. We live in a litigious society. Assets must be protected. Rich Dad advisor Garrett Sutton founded Corporate Direct to provide strong and effective asset protection for all investors in America. Corporate Direct offers personalized attention to your specific situation and is very affordable. Call 800-600-1760 and mention Get Rich Education for a $100 discount on all formations. Garrett Sutton wrote Loopholes of Real Estate, Start Your Own Corporation, and Toxic Client, among other bestsellers. He and his experienced team at Corporate Direct want you to be protected right now and with proper corporate maintenance into the future. Visit corporatedirect.com today for a free incorporation kit or call 800-600-1760 for your Get Rich discount. That's corporatedirect.com at 800-600-1760.
This is Get Rich Education's business developer, John Collins, and you're listening to the almighty Get Rich Education with my friend Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education with our guest, David Campbell from HassleFreeCashflowInvesting.com. So, David, what are some of the benefits of being a mortgage note investor? Let's talk about that.
I love mortgage note investing. One, because it's very low risk relative to the yield potential. And so when I am lending my money, the vast majority of notes, you know exactly what your return is going to be, which is the interest rate on that note. And it's very easy to manage a large portfolio of paper. I own hundreds of mortgage notes in my IRA and in my corporate capacity. And in the hundreds of notes, the time involved to manage them is very, very small. Versus if I had hundreds of single-family homes, I don't think I would be able to do anything else in my life except for manage those hundreds of single-family homes. So mortgage paper is very scalable, very easy to manage. You can get a professional mortgage note servicing company to manage your paper for you, provide you your reporting, and it's very easy to look. If the borrower paid, everything's good. If they didn't pay, which is the minority of your portfolio, then you can talk with your note servicer on an exception reporting basis. You know, what's happening there in that particular note. I also love that notes produce a very high amount of cash flow. So when I'm looking at other types of investing, when I look at a single family home, well, there's a lot of benefits to owning direct ownership of real property, the equity growth, the tax shelter, potential hedge against inflation, definitely some cash flow there as well. But usually when we're just looking at a raw number of cash flow, a mortgage note is going to be a piece of real property almost every time from a cash flow perspective. From a total return perspective, I would absolutely expect a piece of real property to outperform a mortgage note. And that's just logically because real property has more hair on it. It's more time intensive. It's less liquid. Real property has a higher degree of risk. Market fluctuation, pricing can go down, but it can also go up, right? So when you own a mortgage note and the property appreciates, your yield doesn't change. Your risk went down, but your yield stayed the same. When you're the property owner and the property price goes up, you make that profit. Looking at mortgage notes versus real property, mortgage notes are a form of real estate investing, but it's significantly less hassle, significantly lower risk if you're buying first position liens with a lot of protective equity in them, and they're scalable. You can definitely build a portfolio of paper when you're working with a broker, and a lot of your deals are going to look very similar, and so you can acquire paper faster. There's also lower transaction costs. When you buy a mortgage note, there's little to zero acquisition costs when you're buying a mortgage note compared to when you're buying a home. as you know, there's title and escrow and appraisal fees and inspection fees and closing costs and transfer tax, and there's all kinds of costs associated with buying. Mortgage notes are also very liquid. You can sell a mortgage note in a matter of a week or 2 weeks, turn a note into cash, and the costs to sell a mortgage note are significantly less than selling a piece of real property. So a lot of people will use mortgage notes as a form of cash reserves. So a mortgage note is not as liquid as your checking account, but it's still pretty liquid. You could buy a mortgage note, and if you did have a need for liquidity, you could sell that mortgage note at a nominal transaction cost, get your liquidity back. It's kind of like you could buy a 5-year CD at your bank. And when you buy a 5-year CD, you get a higher rate of return than, say, a money market account. But there's a little bit of penalty assigned with breaking that CD early. And that's kind of the same with a mortgage note. You could buy a 30-year mortgage note and hold it for its full maturity, or you could hold that 30-year mortgage note for 6 months and then sell it to another investor who's going to hold that mortgage note. And ideally, the transaction costs on that flip are less than the interest that you made in that time frame. And so you're still profitable.
Yeah, that liquidity component can be really important because us as investors, it's prudent to have some liquidity. I've put out there previously that for every, say, $1 million worth of real estate you own, you'd want to have 40 to 50K in some liquid reserves. Usually 4 or 5% is a good number. And the problem with having that tied up in liquid reserves is your return from a CD or a money market account is going to be even less than the prevailing rate of inflation today. So this way we can kind of get our liquidity, not quite as quick with the liquidity, but maybe be able to sell the mortgage note in just 2 to 3 weeks' time and be able to get a great return. And it could be a really nice trade-off. So, David, let's look at some actual numbers. Let's talk numbers here. Why don't you give us a real-life example with numbers on a performing loan?
So my favorite market for buying and selling mortgage notes in is the North Texas market, specifically Dallas-Fort Worth. So in Dallas, home prices are very modest compared to a national average. I really like B-caliber neighborhoods and homes that are just slightly under the median home price. So an average deal for us might be, say, a $100,000 home, and a borrower would put $20,000 to $25,000 as a down payment, and then we would create, for example, a $75,000 first mortgage, and the interest rates for consumer finance loans are regulated. At the moment, to avoid the regulation associated with a high-cost mortgage, the maximum interest rate that a lender can charge is the annual prime offering rate, APOR, plus 6.5%. And that's generally about 9.5%, 10% interest rate is that the rate that can be charged to that particular consumer. So you're getting a $75,000 loan secured by a $100,000 home, interest rates in the high 9%. Sometimes the investor is earning an origination fee along with that particular note. Or another way to say it is whoever the original lender was, they charge the borrower an origination fee. The borrower pays the origination fee to the broker, sometimes additionally to the investor who's going to hold the paper. They sometimes fee share in that loan origination fee, which adds to the yield to that investor. So maybe they're getting 9.75% plus a 1% origination fee earned at the beginning of the loan to the investor. Also, a huge thing is looking at servicing costs, because for a mortgage to be a hassle-free investment, it needs to be professionally serviced, particularly when your borrower is a consumer. There is a tremendous amount of legislation and regulation protecting consumers from creditors, and that's basically what you would be as a creditor. And you want to make sure that the people who are doing the debt servicing, the debt collection for you, are licensed and bonded, insured. I wrote an ebook called Secrets of Hassle-Free Cash Flow Lending. And in that free ebook, I specifically say, don't make loans to consumers. And that's really to be taken with a grain of salt, because it's assumed that the reader is going to try to remove their own appendix and do that for them. try to do their own loans. Making loans to consumers is a very regulated space. Doing servicing of a loan where the borrower is a consumer, meaning it's their primary residence, very difficult space for the average investor to navigate. If you're trying to do loans to rehabbers, for example, and then that's a business-to-business transaction where you as the investor are making a business loan to a borrower who's using the loan for business purposes, that's a significantly lower regulated space. So if you want to try to create that paper yourself with the assistance of your legal team, that's a very doable thing. If you're trying to create loans where the borrower is using your primary residence as collateral, I would say you've got to have a really strong licensed brokerage team involved to help you through that compliance process.
Okay, David. So in the example with some real numbers where we went ahead and gave a borrower a 75% loan on a $100,000 property, I just crunched it out on a calculator here. So with a $75,000 loan with a return or an interest rate of 9.75% for the investor that's making the loan, it comes out to a little over $600 per month of cash flow.
Yeah, and when we're looking at cash flow, that cash flow is going to be a portion of it is interest income, and that's your profit. And that, unfortunately, is currently taxed as ordinary income. So it's not very tax efficient income if you're making that loan in your personal tax capacity. And then a portion of that monthly payment is usually your principal, which is your own money coming back to you. Your own money coming back to you is not taxable. It's a return of your basis. Sometimes if you were to buy a note at a nominal discount, meaning you don't pay 100 cents on the dollar for the note, that portion of the note that represents your discount on paper, it could look like from the note servicer that it's your principal coming back to you, but you know that a portion of that principal is actually your profit because you didn't pay 100 cents on the dollar for that particular note. And that portion of the principal might be taxable if it's represented as your return. Even though it looks like on the servicer that it's return of principal, you know that a portion of that is your profit from the discounted purchase price.
Okay, so that figure of a little over $600 I put out there as the cash flow, that's, of course, the interest portion of the payment that the borrower makes to us, the lender, and that's the portion that's taxed at ordinary income tax rates.
Yeah, and so when you're looking at your monthly cash flow, your actual check from the borrower would be significantly higher than the number that you said because you're going to get your fully amortized loan is going to include principal payment. Also, I really stress that all of our borrowers pay a fully impounded, fully amortized payment. So a fully impounded payment means that they're paying principal, interest, that's the fully amortized loan, principal and interest payment, and then they're also paying taxes and insurance so that each month you're getting those taxes and insurance held in an escrow account. So when the tax bill is due and the insurance bill is due, the lender has the money for that. The reason that impound account is so important is because those property taxes, if they aren't paid, they become a senior lien ahead of your deed of trust. And the reason that insurance is so important is if the insurance isn't paid and then there is fire damage to the property, it's impairing the value of that collateral, which could impair the value of what you would get in a foreclosure sale for that collateral. So as a lender, we're always needing to be named as the lender loss payee or additionally insured on that casualty policy, that casualty insurance policy. And then the holding of impound account funds is also extremely regulated. So if somebody is buying paper in the secondary market, which is where I would encourage all of your listeners to really participate in, is not on the creation of paper, but the purchasing and sale of paper that already exists, because that market of secondary paper is gigantic. Almost the vast majority of loans that are created are sold. Very few lenders hold that note in their portfolio for the full maturity. So participate in that secondary market where you're buying and selling mortgage notes that already exist, and then work with the servicing company to collect that payment, do the tax reporting to you and the borrower, and to follow compliance on the proper way to hold those escrow funds for the borrower.
Okay, so in our example, I think of a few ways that a listener can participate with that $75,000 loan that they would make. They would have to have that as a lump sum of cash. They couldn't borrow for that. Or they could go ahead and originate a home equity line of credit from their primary residence or from a rental property, and they can go ahead and create arbitrage there. If they have a 4.75% HELOC rate and they go ahead and invest that in a mortgage note that pays 9.75, they just created 5% of arbitrage that way. And then I think of IRA monies too, and IRAs might be a more efficient vehicle than cash.
Yeah, I love using my IRA for mortgage paper because the IRA pays cash for the note. You're right that the vast majority of private lending is done unleveraged or from, as you said, like HELOC or proceeds of a cash out loan. Big banks can definitely create leverage on their mortgage portfolio, but average, mom and pop investors are not. They're paying cash for their mortgage notes. And an IRA, I think, is the perfect vehicle for using to invest in mortgage notes. 100% of my IRA is invested in mortgage paper. I own mortgage notes in addition to what's in my IRA, but 100% of my IRA is in mortgage paper because the income that goes to my IRA is tax deferred. Interest that I would have paid the ordinary income tax rates on if I owned it personally becomes tax deferred, or if it's a Roth IRA, becomes tax free by my IRA owning that mortgage note. So the borrower makes their payments to the servicer, and then the servicer sends that money to the IRA custodian. And the IRA custodian holds that money for the investor to reinvest or to make distributions to the investor when they're ready to start getting their distributions.
Well, you're a broker for these mortgage note transactions. If someone comes to you, how can someone really know, I guess, a good mortgage note from a bad one?
So when I look at a mortgage note, I'm looking at the fundamental question, am I profitable if I'm repaid? Am I profitable if I'm not repaid? And the third piece is this packaged well to be in compliance? And do I have enough documentation here to avoid a claim for predatory lending? And do I have enough documentation here that if I need to resell this note in the future, that someone asking me for the information, I'd be able to provide them all the documentation that they would be looking for. So, and then maybe a next question is this transaction up and up? Is it fraud or is this a real deal? Because unfortunately, there is a healthy amount of fraud in the private lending space where people are either selling notes that don't exist, or they're selling notes that they don't own, or they're selling notes that they say are first position liens, but are actually second, third, or fourth position liens, or they're selling notes on properties that have some type of title deficiency, meaning that the note is good and fine until they foreclose, and then when they foreclose, they might have trouble reselling the underlying collateral because of a break in the chain of title or some other deficiency in the title that would prevent them from selling it to a market cash buyer who needs a title insurance policy. So on that last component, when we're working with borrowers, we want to have them be compliant or RMLO compliant. So working with a licensed RMLO, registered mortgage loan officer, who's putting together a compliance package. And in that compliance package, we want to see that their debt to income ratio is healthy, generally less than 45% debt to income ratio. We also want to see that they have sufficient residual income, meaning that they have enough, not only percentage of their income, but gross dollars, that the gross dollars remaining at the end of the month are sufficient to sustain someone in a reasonable lifestyle. We also want to see that interest rate is low enough to not be considered a high-cost mortgage, just because the compliance complexities increase significantly if it's considered a high-cost mortgage. We also want to look at the borrower's income documentation to see that the documentation that they provided is reasonable to match that loan application. So the borrower is going to sign a loan application that says, under penalty of perjury, here's my income, here's my expenses, and as a lender, we could take that at face value, but we do have a little bit of responsibility to look at the supporting documentation to say, I think this loan application is reasonably truthful. So we're going to underwrite that borrower to avoid a borrower saying, Mr. Lender, you took advantage of me. You made me a loan that I couldn't afford, and now I am a disadvantaged consumer. So we definitely want to look at the borrower's income, their capacity to pay. Their credit in a private lending transaction doesn't really matter, because when I'm looking at their capacity to pay, that's very important, and then I'm looking at the collateral as my security. And I know from personal experience in studying industry that a borrower who has significant equity in their property is highly likely to pay their home mortgage. Who cares what their credit score is? They might not pay their credit card, they might not pay their car, they might not pay their cell phone, but they're going to pay their mortgage, because if they don't, they're going to lose their equity, they're going to lose their place where they live. And, candidly, if they had perfect credit, they probably wouldn't be in the private lending marketplace being willing to pay 9 to 10% interest rate. They'd be down at Bank of America getting the money for 3 to 4%.
And we wouldn't even have an opportunity.
So when I see that bad credit, that is the opportunity, right? So when I'm underwriting a loan file, conventional banker is going to see bad credit and say, red flag, sorry, we can't do your loan because Fannie Mae, Freddie Mac will buy this note. As a private lender, I like looking at that borrower's credit, seeing some type of deficiency, and saying, here's a great opportunity. We can help this borrower. They have a need. We're giving them a loan that's the similar cost to rent, so it's a very fair situation for them. We also work with note servicers that report to credit bureaus. And so the borrower is getting their positive payment history reported to the credit bureau, which allows them to heal their credit and allows the borrower the opportunity to refinance once they get their credit issue fixed.
Well, this is great, David. This gives us a lot of things to think about that traditional equity buy and hold investing doesn't. What are some other things that can go wrong? I mean, any other risks or red flags, things we need to be careful for?
So if a borrower is paying you, pretty much that is the most likely outcome. But if you do have to do a foreclosure, the things that you're wanting protections on, or the things, the due diligence questions that you would ask on the front end. One, is the note that you're buying, is the deed security instrument that you're buying, is it recorded? And can you get a copy of the recorded instrument? The deed of trust that you are foreclosing upon, was it properly assigned to you in the documentation behind that particular assignment? And the other thing is property taxes. It's very possible that there could be a property tax lien in that history, that chain of title, that you can uncover through a tax certificate or just your independent research of property tax history, because you're buying that lien priority, that foreclosure, you get paid after the taxing authority gets paid. And so that's kind of an exciting thing about note investing, is the security behind it, is you are going to get paid or you're going to get the collateral. And if you get the collateral, will you be happy? Will that collateral be good outcome for you? And if the answer is yes, you're happy to get the collateral for the amount of your investment, that's a good note. And if the answer is no, you don't want the collateral for the amount of the investment, I would generally suggest passing on the opportunity.
Well, I think the big picture here is this is just another instrument, another vehicle, mortgage note investing, that you can employ in order to turn your equity into cash flow and maybe help set you free. There's a lot of people working at jobs, plowing money into something that's not liquid and doesn't provide cash flow. This does both. David's really the person that can help sort of hold your hand, hook you up with the right deal, and he knows about all those red flags to look out for because he's a very experienced mortgage note investor himself. David, how can our listeners find out more about you?
Well, Keith, I really appreciate you sending people to my blog at hasslefreecashflowinvesting.com. And when you're at hasslefreecashflowinvesting.com, I've got a free report, lots of free reports, but specifically free report on private lending. If you go to hasslefreecashflowinvesting.com/GRE, like Get Rich Education, and there's a free report just for your listeners.
David Campbell, with your 5 appearances, you are a record-setting guest. Congratulations, and thank you for coming back on to Get Rich Education. Yeah, well, you just can't put an ad on Craigslist saying that you'll make someone a home loan and then you can arrange that they pay you 14% interest. It just doesn't work that way. It's a regulated industry. Know the rules. Avoid fraud and talk to a broker like David Campbell that can help you do this and start at hasslefreecashflowinvesting.com/GRE. I will be back next week to help you build your wealth. Until then, don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.